All right, good morning, everyone. Happy Saturday, the 5th of April. Let's do a quick sound check here. We'll get jumping on in. I'll try not keeping y'all for too long. I'll get you in and get you out. All right, good morning there, AJ. Good morning, Maddie, Andrew, Renee, Sarvesh, Eric. All right, guys, where to begin? We got a lot to cover. Fun fact here on the S&Ps. We closed Friday a good 5.5% to 6% below the hourly 21. And we close a good 11-12% below the daily 21. And then for the QQQ, you are about 6.5-7% below the hourly 21 and about 12.5 to 13% below that daily 21 EMA. Which just means to me that we could wake up to a 5, 10, 13% higher Monday morning. It ain't going to change all that much in terms of all the sell signals, in terms of structure. Market has taken quite the beating here. I say that to say, in a bear market, you're going to get your biggest bounces. So you wake up Monday morning and S&Ps are up 1%, QQQ's up 2%. You can maybe play the pop for a day trade. Picture changes nothing. We're not at a point where we can get a little pop on a 15-minute time frame, a little pop on a 30-minute time frame, and we're fixing all the issues. We got bigger issues than that. But all right, taking a look at the big three sheet, we are officially into bear territory. The indexes are at negative 74% of max strength, which means they're about negative 25% away from the weakest score possible. Big 10 baskets at negative 67% of max strength, sectors at negative 63. And combined then, we have a market at negative 66% of max strength. Pretty bearish. QQQ has negative 85 out of 120 points. S&P's negative 85. Dow Jones negative 85. RSP a negative 89. And the IWM a negative 102. All right. And remember, the worst possible score they can get is a negative 120. Small caps are 18 points off. QQQ's getting closer. And then down here for the Big 10 basket, everybody goes negative. Netflix a negative 51. Tesla a negative 69. And then a couple stinkers down here. Apple negative 87, Google negative 91, Microsoft a negative 98. It's a lot of negativity. And then the only green on the board would be gold. So we're banking on gold to save the entire stock market at this point. Gold with a 54 out of 120, and then you got the drop off. All right, Bitcoin negative 33. Quite the fall from Grace and silver. I think back on Wednesday of last week, silver had a positive 90. They dropped that to a negative 44. You've got the Big 10 basket at negative 85. Semiconductors a negative 96. XLK a negative 96. And at the moment, the worst sector would be biotech with a negative 114. But more importantly, guys, nothing we can jump in there and buy. Maybe for a day trade, maybe for a short squeeze bounce. But from a bigger picture perspective, nothing's bullish anymore. Maybe gold, and even gold a bit of a drop off. Right, gold had a perfect 120 a couple of days ago. They're already dropping that to a 54. Index is bearish, Big 10 bearish. Pretty much everything is bearish. And like I mentioned, we're not at a point where one little good pop on Monday morning and hey, we're back to a bull market. It's going to take a lot more than that. If they can gap up the QQQ by 20% tomorrow morning, that might fix all the issues. But one thing I did notice looking at the charts last night, they've even taken the monthly charts to a point where they're taking some damage. And that's kind of been the bulls' potential saving grace during that pullback. All right, we put in the top, we're pulling back, and the hourly charts look awful, the daily charts look awful, weekly charts look awful. The one little thing bulls had in their back pocket, good-looking monthly charts. And a bit of that change is back here on that candle. QQQ monthly, you drop from a 15 to an 18. Now, looking at it objectively, it's not a bearish monthly chart. You don't have a sell signal. You don't have momentum below zero. You don't have negatively stacked EMAs, but it's not as strong as it was, 1, 2, 3 candles ago. Pulls back to the 21 EMA, breaks that 21 EMA, and now for the first time since, let me see. Now for the first time since August of 2023, we no longer have a QQQ monthly buy signal. Monthly chart for the S&Ps. All right, they pull it back, and you're taking damage on 30-minute time frames, hourly time frames. Then you're taking damage on your daily chart. Then you're taking damage on your weekly chart. Now we're taking a little damage here on the monthly chart. Back below the 21 EMA, they cancel the sell signal, or they cancel the buy signal, rather, for the first time in December of 23, a year and change. So to me, that means the whole idea of, all right, maybe it's just a pullback back to the monthly 21 EMA. And then the market at the bottom, and that's all she wrote. And we're jumping back in, getting long, and we all live happily ever after. It was a good conversation on paper. Right? Big push, pullback. They hold it, they rebuild. Then down the road, you're kicking off for another leg towards an all-time high. I think the quick move back below that monthly 21 EMA pretty much puts the lid on that idea. If they can't hold their monthly 21, they can't continue the monthly uptrend. So pretty big damage there. S&P's QQQ. And then even more importantly, a few of your big leading names. Here's a monthly chart for Apple. Yeah, if they pull it back from the 260 high down to that 210 21 EMA, and they find certain, they hold it, and they give you some hourly buy signals, daily buy signals, you want to buy that dip. I don't think you want to buy it now under your 21 EMA. No more monthly buy signal. All right, what about an Nvidia? Little bit below that monthly 21. You got a monthly buy signal back on your April 23rd candle, and now for April 25, you are losing your monthly buy signal. And that doesn't mean, okay, you got to short Nvidia, and Nvidia's going back to $40. It just means you want to be very, very, very careful about jumping in and trying to buy it. Again, if they trigger a big push off the monthly 21, they pull back, they hold it, they give you a bunch of buy signals. Yeah, you jump in and buy that dip. Back to support, fail to hold support, and then you're getting loaded with a daily sell signal, 4 hour, 2 hour, 1 hour, 30. You can't be buying that just yet. So the spreadsheet has flipped bearish. We've lost our monthly buy signals. And then the other thing I'm seeing here is, and again, guys, it's a little bit twofold, I think, heading into Monday. From one perspective, you look at the spreadsheet, you look at all of the chart structure, the sell signals. It looks like a market that might want to go limit down on Monday. And frankly, tomorrow night when the futures open, if we're down another 4, 5, 6%, I'm not going to be shocked. That's how crappy the signals are right now. That being said, though, like I mentioned at the beginning of the call, have the proper context. We all wake up Monday morning and boom, S&Ps are popping, QQQ's popping, Google's green, Nvidia's green, Tesla's green. Human nature will tell you jump in and buy them. Approach it with a little bit more context, and I think good context is, again, they could gap it up 3, 4, 5, 10% Monday morning. It ain't going to change too much, right? We could watch QQQ pop 5.5 to 6% higher Monday morning. That won't be that won't be anything more than a push back to a falling hourly 21. They're not going to fix hourly structure. They're not going to fix the hourly trend. You're not going to get a bunch of 15-minute, 30-minute hourly buy signals. It'll be a big pop. I think you could play that pop, but it won't change anything. So don't be the guy or girl where S&Ps are green tomorrow, QQQ's green tomorrow, or Monday rather, and you're jumping in getting a bunch of swing longs. Day trade it, look for a short squeeze, scalp it. Be very careful about taking those calls to bed. You can take them out to lunch, right? Day trade them, wine them and dine them. Then before the close, I think you drop them off at the back at the bus stop. So could we get a big pop on Monday morning? Yeah, definitely. Very, very oversold market. One thing pointing towards you might not get that pop. Or better yet, guys, if you do get that pop, you want to short it. All the squeeze is already breaking short. Makes for a really interesting dynamic where we already got a big flush. We're already very oversold. But then take the QQQ, for example. From a squeeze perspective, the bears are just kind of getting waken up here. They have just fired a daily squeeze short. Right, build up the energy, and now they release the energy. They have also just fired a weekly squeeze short. And again, you're pretty oversold, so a bounce would not be the craziest thing. But you're bouncing in the context of what? If we do get a bounce, we are bouncing in the context of really, really bad scores. Everything ranked out bearish. We are bouncing in the context of really bad structure. We're bouncing in the context of nothing but sell signals. And then to me, more importantly, we're bouncing, if we do bounce, in the context of big squeezes trying to break short. Again, I can day trade that, but I'm not going to fight that as far as a swing trade. QQQ daily broke short, QQQ weekly broke short. If we jump back to the S&Ps here, they just fired a weekly squeeze and a daily squeeze short. If we look to an NVIDIA, none of it good, guys. NVIDIA fired a daily squeeze and a weekly squeeze short, which might imply they want to take it down to about 80 and change. So, when a squeeze fires, that's what they tend to want to do. Rally about 3 ATR above our 21 EMA or flush about -3 below it. That -3 ATR for NVIDIA is going to be about 82 to 85. So Monday morning, we wake up and we're getting the pop. We got good internals. NVIDIA's popping. Yeah, day trade that for a long. Buy it on a good-looking 15-minute squeeze. Buy it on a good-looking 5-minute squeeze. Don't forget bigger picture. You just fired a weekly squeeze short. Day trade the pop long and then swing trade that pop short. What else we got here? Microsoft. Right, very beaten down, very oversold, but it just fired a weekly squeeze short and it also just fired a daily squeeze short. All signs pointing towards path of least resistance being to the downside. And then folks in my room, I know you're all familiar with our Big 10 basket. So this is these 10 names, right? Amazon, Nvidia, Meta, Tesla, Google, Netflix, Microsoft, Apple, and Broadcom. This basket is those 10 names in a weighted ETF. So think like a QQQ or an S&P. So if we look at the Big 10 basket, again, like everything out there, you're very oversold. Any kind of pop Monday, Tuesday, Wednesday will not be the craziest thing. But you are popping in the context of what? Generally, a dumpster fire. Daily squeeze broke short. All right, that'll want to take you lower. Weekly squeeze just broke short. That might want to take the basket down to about 77, 75 and change. Monthly chart on the Big 10 basket couldn't quite hold that monthly 21 EMA. And again, I think in the background here for the Bulls, that's been the one potential saving grace. Yeah, we're pulling back. Yeah, things are ugly. Yeah, we got a bunch of broken structure, bunch of sell signals. But, right, they had that one but the monthly charts are still bullish. I'm not going to call them bearish, but not a good hold there of support. To want to jump in and buy the QQQ, S&P's Big 10 for a swing trade idea would be a lot easier if they pop it, they pull it back, and then they're holding that monthly 21 and Yeah, making our job that much easier. The break, I think, requires a lot more caution on the buy side. So bigger time frame squeezes all breaking short. And then depending where things open up for Monday, think back to Friday's open. I think NVIDIA being a good example. So you have a really, really weak Thursday. Everything pulling back. And then by Thursday's close, you got a lot of end of day 15-minute squeezes. For those of you who follow Henry Gamble, Henry loves these end of day 15 minutes. All right, so here's NVIDIA. They gap it down and pretty much a choppy back and forth Thursday. By Thursday's close, there's your squeeze for a short. White arrow, negative 15, broken momentum, broken trend, broken structure. In the context of the current market being a lot more bearish, that kind of pattern end of day. All right, gap it down, chop it, build up all the energy. They got a real knack for wanting to fire short the following morning. Gap it down. NVIDIA's catching its breath, drinking the Gatorade. 15-minute squeeze, opening bell, boom. Gap down, fire short, and continuation lower. Had one in NVIDIA. I think we had one in, I want to say Microsoft. I believe the Microsoft. Yeah, there you go. Right. Gap down for Thursday's open. Chopping, 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 chopping. End of day 15-minute squeeze, and it breaks short into Friday's open. So along the same lines here, down on the Big Ten, we have a 15-minute for Amazon, NVIDIA, Meta, Tesla, TSM, Google, Netflix, and Microsoft. And then indexes, we have one on the Big Ten basket, the IWM, the QQQ, and the RSP. So one argument could be, hey, we are really oversold. We're due for a bounce. Everybody's getting bearish. And maybe Monday morning does bring a little bit of a pop higher. Right now, we don't have the signals to call for a pop higher, but we could get one. And not to be a broken record, but if you get a pop in this market, day trade the pop long, swing trade the pop short. Meaning, okay, QQQ, Monday morning, everybody's heating up, turns a corner. All right, if they want to take it back to the falling hourly 21, I'll day trade the entire move higher. And we're at a point where a pop back into an hourly 21, it's going to be a very big move. It's like 5.5 to 6.5% of a pop. I can day trade that pop. Wait for a 5-minute buy trigger, jump in and get long. Buy a pullback to a 5-minute 21, buy a 5-minute, 15-minute squeeze. That move higher. We get back to an hourly 21, we get rejected, we keep the sell signals. That could be a good spot to get swing short. Day trade it long and swing trade it short. But all right, for a few of these 15-minute squeezes here, if they do gap down Monday morning, how much more damage could they inflict? Let's go look at Amazon first here. We'll do a full walk down. All right, Amazon monthly is under the 21 EMA. No bueno. Amazon weekly is, I'm not sure what we call that. Yeah, I'm looking for a technical term. I don't have one for that. Monthly 200 around 155, 150. And then Amazon daily chart, just really beaten down. Again, you're pretty oversold. Been there sometime this week, or it could be a case of Monday morning, S&P's gap down, QQQ gaps down, and Amazon fires that 15-minute squeeze short. Better yet, guys, Monday morning's open is a bit more flat. And we're not getting a big gap down, not getting a big gap up. Take these 15-minute squeezes, look for an active idea. We open up flat on Monday, and then the internals roll over. Ticks are down at minus 1,000. VIX is popping. Hey, if you got a 15-minute squeeze in Amazon, NVIDIA, Meta, all the above, that might be your short. I think you're shorting rallies or you're getting short in lower time frame squeezes. So Amazon, let's see, NVIDIA. I mean, I got to think at this point for NVIDIA, they might want that weekly squeeze target around 85 and change. So not to say a 15-minute squeeze break short, and that takes you down directly to 85, but that could be a good target, and I think you play for a path towards that target through those kinds of setups. 5-minute time frame squeeze, 15-minute time frame squeeze, a 30-minute hourly, all the above. Versus, hey, here's NVIDIA looking really, I'm going to jump in and blindly get short. You will have temptation in this market. I'm going to jump in, I'm going to buy a put, and I'm along for the ride. I think you want to pick your spots wisely. I was at a live event in New York yesterday, a live trading event. And of course, we were all short in the market. But, one thing I did notice yesterday, for example, they might flush the S&Ps, and then at the bottom of that flush, you might be looking at an out the money put going for about, call it $5 and change. On the flush, you can buy an out the money put for, $5 per contract. Given the implied volatility right now, it does not even take a big pop at all to take that put from $5 down to about 2.5. I think that's where there's a lot of benefit to waiting for a squeeze. Right, NVIDIA gaps down, big flush. If you're buying the put anywhere during that flush, when NVIDIA finally takes a bit of a breather and you're chopping back and forth, building up the energy, brand new squeeze, that put you bought on the gap down, even though NVIDIA might be at the same price, that put could be down 10, 15, 20, 50% just because of the implied volatility. That's why I think the squeeze is very beneficial. Let NVIDIA gap down, let it flush, then wait for your chop. Little back and forth, brand new 15-minute squeeze. That little bit of a chill pill can cool off those options premiums. And the IV is still pretty jacked up, so not so much. But I think a lot to be said for wait for a squeeze, buy them when they're cheaper, then try to catch that next flush lower. So 15-minute on the NVIDIA. Let's go look at the 15-minute on Netflix. And for those of you in my room, think back to Monday, Tuesday, Wednesday of last week. Netflix was showing really good signs of relative strength. Compared to the indexes, compared to the other Big Ten names, compared to most things on the board, Netflix really, really held up well. We don't want to play the needle in the haystack game. Amazon looks awful, Apple looks awful, NVIDIA looks awful, everything looks awful. But hey, I'm going to jump in and I'm going to buy some Netflix. You don't want to play that game. Everything we've seen showing signs of relative strength, they're taking a good hit here. Netflix drops from $9.50 down to $8.50. Cool $100 haircut. You had really good relative strength in silver. Look what they do to silver. A good old whooping. Right? So you can't swing trade this market to the buy side. I would like to think I'm a pretty good swing trader. I can't do it right now. Anything I would have thought about buying for a swing, I would have gotten my butt handed to me. Silver, even gold, right? Gold still ranks out pretty good. But if you're jumping in and you're doing the swing trade game all the way up here, now you're taking damage on the pullback. There was Alibaba. All right, here we go. Good looking daily squeeze, bunch of buy signals. I know, just like the good old days. And if you jump in and try to swing trade that, you're not having too much fun. There was McDonald's. All right, here we go. We got the white arrow, big push, and then right back down. And then, all right, here comes round two, big push, and right back down. This has nothing to do with McDonald's. That big flush in BABA had nothing to do with Alibaba. I don't think the flush in gold or silver had anything to do with gold or silver. We're not in a market that supports things trending higher. That would look like, think of Q4 of last year, guys. What did our spreadsheet look like in Q4 of last year? It's incredibly obvious. You got to go out there and get long. We had the indexes at 90% of max strength. Now we're at negative 74. We had the Big 10 at 90%. Now they're at negative 67. You had a market back in October, November, December that supported getting swing long. You don't have that anymore. So day trade them longer, scalp them. Very careful on the swing side. If anything, right now we have the opposite dynamic. Bearish on the spreadsheet and big squeezes breaking short. That Q4 push we all loved, it was just the opposite. Bullish on the big three sheet. And then here comes Apple in a beautiful weekly squeeze. But here's the kicker. If back when you had that Apple weekly squeeze, the kicker was the entire market looked like Apple. Big squeezes setting up, bunch of buy signals, perfect structure, perfect trend. The ideal moment in time to get aggressively swing long. We don't have that anymore. We have the complete opposite. Bearish on the spreadsheet, big squeezes short. Weekly Apple, weekly QQQ, weekly S&Ps, weekly Big 10, weekly NVIDIA, weekly Microsoft. You name it, they are firing short. And again, guys, most important thing to keep in mind for the week ahead, you will get your biggest pops in your weaker markets. Big flush, big gap down, big flush. Yeah, at some point in there, you're going to have a day where QQQ's up 3, 4, 5%, and it'll look bullish, it'll feel bullish, it'll smell bullish. It might be nothing more than a pop back into a falling 21 EMA. The pop that can change everything will be the pop that brings you 15-minute, 30-minute, hourly buy signals. It'll be the pop that cleans up your daily structure, cleans up your weekly structure. It'll be the pop that brings our Big 10 names back to life. Not pops back into falling 21 EMAs. So the game plan we are going to work is a day trading game plan. And you might be thinking, well, why not get swing short? If the spreadsheet is bearish and the signals are bearish and the squeezes are all bearish, why not wake up Monday, buy a put, and hold it for a flush lower? I love the idea. I want to do exactly that. I don't want to do that when we could pop about 6% Monday morning, and that'll be my pop back to an hourly 21. That's actually what I want to short. Let them find the bottom, let them pop it, day trade it higher. Then can I get short under a 30 EMA, an hourly 21 EMA? We want to get real crazy here. Maybe a rally back to your daily 21 EMA. Good 12.5 to 13% pop in the QQQ. So on a good pop, we can day trade it long. At some point on that pop, we want to get swing short. If we don't get the pop Monday morning, we can get short, but I think we do that for a day trade. I don't want to go to bed holding a bunch of puts and the S&Ps are 8, 9, 10% below an hourly 21. You could wake up and get totally ran over, but nothing changed about the market. So same focus as last couple of weeks here, guys. And none of our trades have been big home runs or big multi-day movers. They've been more like think of all our gold futures trades. None all that impressive. None of them really sexy, but they're getting the job done. Right? Wait for a 15-minute, 30-minute, 1-hour squeeze. Jump in, catch the entry, catch the push, and then get the heck out of there. So we're catching gold. Let me see. Just moment like these. Little look in the action, brand new hour squeeze, trend, structure, momentum. I'm not taking that and calling for a week-long rally. Can I buy it Monday morning, catch my push, take my profit Monday afternoon, go to bed in cash, get a good night's sleep, and then I don't care if the next morning they're gapping gold down 5, 10, 15, 30%. I'm not going to get caught swing long. Wake up in cash, look for a 15-minute, 30-minute, day trade it, keep on moving on. But now, as we do that, we want to have a focus on that concept of relative strength. Whether it be a 5-minute time frame, whether it be a 30-minute time frame, whether it be a long or a short. If I'm buying something for a day trade, I don't want to buy the weakest name on the board. Meaning, for conversation's sake, Monday morning we gap up, and at least for Monday's open, things look a little bit more bullish. Right. If I'm going to go trade a 15-minute, 30-minute squeeze long, I don't think I want that to be in biotech. The worst on the board. I don't want to look in XLB, ARC. I don't want to look in Microsoft. Can I find that day trade long in a spot showing some kind of relative strength? Now, in this market, that could mean you're taking Netflix over Microsoft. Neither of them are good. Neither of them are bullish. But relative strength-wise, Netflix with a negative 51 is better than a Microsoft with a negative 98. I would go with Netflix over Microsoft. Wake up Monday morning, market looking bearish. Surprise, surprise. If I want to get short, I don't think I have to go and try to short gold. I don't want to walk onto the jail yard and pick a fight with the biggest guy out there. I want the easy pickings. I'm going to go short an IBM or an IBB. I'm going to short SMH, XLK. I'd rather short Google over Netflix. So we do want to keep that concept in mind. Day trade, swing trade, long, short, big time frame, small time frame. Whatever we're doing, are we doing that on the best the board has to offer? We're buying 15-minute squeezes Monday morning, Tuesday morning. Okay, are we doing that in the best name possible? And that's why I think the spreadsheet has been really helpful. Context, what kind of market am I in? Is it bullish? Is it bearish? Is it neutral? Am I thinking swing trade? Am I thinking day trade? Very, very helpful. But all right, guys, I think it's pretty straightforward here for the week ahead. Bearish on the spreadsheet, bearish on the charts, bearish in sentiment. And then one more note here regarding sentiment. It will not matter until it matters, and so far it does not matter. And better yet, they keep on getting rewarded. But a lot of retail keeps on heavily buying these put contracts. If you look at the put call ratio, again, does not matter until it matters. It don't matter right now. But we had 1, 2, 3. We had 4 candles last week where that put call ratio popped above a reading of 1.0. Think of that like you got your extremes. You have that 1.0, then you have that, we'll call it 0.4. Anytime your put call ratio is near one of the extremes, there's either a lot of call buying taking place or a lot of put buying taking place. Last week, of course, a lot of put buying taking place. Now, they keep on getting paid. They bought a bunch of puts on Monday. They got rewarded. They bought more on Tuesday. They got paid. They bought more on Thursday. They bought more on Friday. They keep on buying them. They keep on getting paid. There will become a point where folks are too short. They've bought too many puts. And that can create the day where you're getting that big short squeeze pop. QQQ's up 4 or 5%. You're popping back to a falling 21 EMA. You don't want to be swing short during that kind of pop. That's why I think for Monday's session, given how oversold we are, given all the put buying, day trade it short. If we open up flat, day trade it short. If we gap up and pop, then try to find a spot for a swing trade short. got to keep an eye on the old put call. But all right, y'all. Any questions for me? Anything you want to look at? I've got you covered. We will finish up the weekend and tackle the week ahead here. A lot of moving parts, a lot of headlines. Shall not be a dull one. That's our most important piece of advice, though. Keep that thought in the back of your mind. In a bearish market, you will get your biggest pops. And those pops do a great job of doing two different things. One, they can steamroll anybody who got short. Oversold market, keep on buying puts. Yeah, at some point, they're all going to get squeezed out. The other thing it can do, though, hey, guys, give me 10 seconds. I'll be right back with you. I got to take a quick phone call. Hang tight. Hello? Hey, I'm going to call you back after, okay? All right. Calling me during a weekend prep session. These people got some nerve. But as I was saying, in the bear market, you're going to get your biggest pops. Those pops are good at doing two things. One, they roll over anybody who got short. And then number two, they're going to rope in some fresh bulls. All right, we're not talking a 0.5% pop. We're not talking a 1 or 2% pop. If QQQ can get back to an hourly 21, we're looking at a 5.5 to 6.5% rally. That will run over all the shorts, and that will also rope in a bunch of bulls. All right, we're back, baby. Bull market is back. We put in the bottom. I'm jumping in. I'm buying the calls. I'm buying the leaps. We are back to the glory. It could be that, or it could be a pop into a falling hourly 21 EMA. So every day, ask yourself this one question. If we get a big pop, did anything change? And that means in terms of chart structure in the signals. By the time we close up for Monday, if we are back above 450 and we've got 15-minute, 30-minute buy signals, all right, that might have changed a little something. Back above a key level, cleaning up lower time frames. All right, bulls are making a decent effort here. But if we pop up 1, 2, 3, 4, 5, 10%, and we're not back above key levels, and we're not getting better scores, and we're getting a bunch of buy signals, nothing has changed. Day trade that pop long and you get the profit. Then I think with patience, you're taking that profit and putting it back into a short. Alrighty, y'all. Buckle up. Shall not be a dull one. All right, so between YouTube and my room here, I'll go back and forth. And then Danny on YouTube, great question. What would I buy for a bounce? Or just not play the bounce at all? Yeah, it's a really good question. So for one, if I were to buy the bounce, it's either going to be S&P's QQQ or a name on my board showing me signs of relative strength. Right now, for example, QQQ has negative 85 out of 120. That makes Netflix with negative 51 a little bit better. You're about 30 plus points stronger than the QQQ. Neither a bullish, of course, but somewhere in Netflix there's better structure, better momentum. That kind of thought process. If I've got a 2-hour window of opportunity to jump in and get long, QQQ S&Ps or something better than the index. And then to answer your second question, would I just not play the bounce at all? It'd be a signals thing. To me, it can't be as simple as wake up Monday morning, QQQ popping, and all right, here we go. Time to jump in and get long. Can the bulls give me anything to work with? In the current market, guys, that could be something as simple as a 2-minute buy signal. Let the market open, let them flush it, and then be patient. If I can look at my QQQ and I got a 2-minute buy trigger coming through, I might jump in and look for a day trade. But not because, hey, we're oversold, not because we're due for a pop. I've got something to work with. Could be a 2-minute buy signal, could be a 5-minute. Look at the action here on your 2-minute from here's yesterday's action. 2-minute candle or 2-minute time frame from yesterday. Look at all your pops. You had a pop from 434 into 439. No 2-minute buy trigger. We rallied from. It's a good example right here. So put it in percentage form. We bottomed at one from 426. We popped into. Let's see. I think putting things in percentage form can be pretty helpful. At one point, we popped from 426 into I'll call it 438. So think about that. That's about a 3% pop in like a 20, 30-minute window. You popped about 3%. We could not even get a 2-minute buy trigger. Think about that. 3% pop and 2-minute trend, 2-minute structure, 2-minute momentum. They can't even get a bullish. We're not talking about a monthly chart or a daily chart. It's a little old 2-minute time frame. I would not have bought that pop. Never got my trigger to buy it. So, Danny, it's a really good question. One, what indexes or a name better than the indexes? To then want to even go and play for the pop, I need an actionable signal. It can't just be, hey, we're oversold, or hey, we're at a big level of support. I got to get a 1-minute, 2-minute, better yet, a 5-minute buy trigger. And I'm curious as we're looking at it, did we even get a 1-minute? Yeah, so look at 1 minute back here for 1, 2, 3, 4, a grand total of 4 minutes. On your first dip back to your 21 EMA, you've already lost your 1-minute buy signal. Think of how lame that is for bulls. They cannot even keep a 1-minute buy for more than 4.5 minutes. You can't jump in and buy that. And they're walking down. And then later in the afternoon, finally getting some more 1-minute buy triggers. And they keep it, little push, little pull back, and then they drop the ball. But I can work with that. It's not a 1-hour buy trigger, not a daily buy trigger, but it's something to anchor to. Jump in long, and then on the break back below that 21 EMA, I think I got to tap out. So, Danny, really, really good question. Really good question. All right, folks in my room, we jump over here. Hey, Eric, in these markets, will the carry trace still be applicable and worthwhile help gauge it? Eric, that's a really, really good question about the carry trade. Not to get too deep into it, because for our sake, it doesn't matter at the end of the day. I think I think what's happening right now is that they're trying to force the Fed's hand, pretty much. Dump the equities market, take things down, back the Fed into a corner where they got to come out and cut rates. That to me seems like the mission at hand right now. So in terms of, hey, what do we got to get here for a good, decent short-term bottom? I'm thinking either that or some sort of news regarding the tariffs. That might do the trick. But anything else, I think it's just going to be the opposite of your Q4 market. What are we doing back here all throughout Q4? It's everybody's favorite market. Rally away from a 21 EMA, pull back to it. Rally away from it, pull back to it. Rally away from it, pull back to it. Now things are changing direction. Flush away from that 21 EMA, rally back to it. Flush a couple thousand miles away from it, and then eventually back to it. I think we'll be in that kind of pattern dynamic until something bigger changes. whether it be an interest rate thing, whether it be a tariff thing, combination of the two. I wish I had a better answer for you. If I could put in the bottom myself, I would. I would. I would love to be that hero, but that might require me getting heavily short on Monday morning. If we gap down and I jump in and buy a bunch of puts, that might be the bottom for you. I'm not sure I'm going to take one for the team like that, but might have to at this point, Eric. Might have to. And yeah, no magic 8 ball, which is we're all looking for it. It's just human nature. Every trader, every investor in the world right now has the same exact question: when and where will we bottom? If you could figure that out with if you could figure that out with certainty, you'd be the most popular guy or gal in the world right now. What I think would be really big for us is just a day by day mindset. Not getting too caught up in, okay, can we put in the bottom this month or next month? Can we turn the corner higher in June or July? Wake up fresh. No favorites, no biases. Just, all right, what am I working with? Bullish, bearish, neutral, day trade, or swing trade. And then keep on operating based on what the spreadsheet says to do. When the bottom is in, guys, we'll begin to see it here on the spreadsheet. It'll look like things going from really bearish to a little bit less bearish, and then from a little bit less bearish to neutral, and then from neutral to a little bit more bullish, and then back to bullish. All right, full round trip. Right now we're just bearish, and that can be the case all the way up until the end of April. That could be the case up until the end of the calendar year. Gotta take what we can get. And don't get me wrong. What's my ideal market? Like anybody else in the world, give me Apple in a weekly uptrend in a big weekly squeeze with a good market behind it. I love everything about that. I think we all do. It's easy. It's unemotional. You buy a call, you go to the beach for a week, come back and get a paycheck. Everybody loves that kind of market. Spreadsheet is kind of screaming clear as day here. You're not in that kind of market. One day, though, guys, one day, it might be my great grandchildren trading that market for me, but we will get it back one day. There you go, Maddie. There you go. Hey, how are you, my friend? Andrew went to California and broke the market. 15-minute chart on the ES from Friday. 15-minute on Friday around 11 a.m. Let me go pull that. S&P 15-minute from Friday. Yep. Now flip that upside down. So here's the inverse chart of the S&P futures. When the market is bullish and things are trending higher, you can make a living on that one moment in time. I'm in a bull market. The path of least resistance is to the upside. I'm being patient, waiting for a 15-minute squeeze. White arrow, perfect score. Right? You take that, you buy that in the direction of the overall market. The beauty of that is, guys, if you're in that kind of market for 2, 3, 4, 5, 6 months straight, that can be a repeatable pattern. Wake up in cash, watch your 15-minute, 30-minute, 1 hour, 2 hour, wait for a squeeze, wait for alignment, look for a good entry, get your piece, and then get the hell out of there, right? Over and over and over again. And I think for a lot of retail traders, that's a very easy thing to do. Bull market, wait for a dip, wait for a squeeze, get long, and ride that wave. We don't have to reinvent the wheel when things change direction. Current market is a little bit more bearish, right? Path of least resistance is lower. Be patient, sit back, wait for a 5 minute, 15-minute, 30-minute bear squeeze, arrow pointing lower, get alignment, get a good entry, get short, catch your flush, get the heck out of there. And guess what? We're in this kind of market for another 2, 3, 4, 5, 6 months. That will be a repeatable opportunity. You don't got to short a gap down. You don't got to get short first. Wait for a squeeze. So much edge, guys, around waiting for a squeeze. Options pricing cools off. That might be the biggest benefit in the current market. But yeah, Andrew, that's a textbook example of what I want to do in this market. S&Ps are weak, internals are weak, VIX is up 70,000%. Look for a squeeze to get short. Yeah, beautiful example. And you might have a day, guys, where here's a tough thing about that day trade mentality. There might be a day where you're going to get that moment in time on a 5 minute, 15 minute, 2, 3, 4, maybe even 5 times. There's also going to be days where you might get that one time during the session, you might get that 0 times. Wait for it, take it when you get it. Yeah, great call out, Andrew. It's perfect. That is perfect. Maddie watching S&Ps into 3,800. You're scaring me, Matt. All these spooky stories I'm hearing over the weekend. Well, we'll find out, guys. That's the fun part. We can do it as a group, do it together. Yeah, I mean, we'll find out, man. We'll find out. You got to love the easy markets for the financial plate of opportunity. And then I think you have to love the hard markets for the opportunity to sharpen your skill set. Uptick in volatility, things are moving faster, more dynamic. If we can get better in this kind of market, imagine next time we're back into a Q4 kind of market. Better yet, a 2024 kind of market. Will feel like a walk in the park. David, another good question here. If I could get on more than one time frame, what time frame would I use? So, David, are you asking about? You asking what's a multi-time frame combo for day trades? Is that what you're asking? If that is your question, one combo I'm liking a lot in the current market: the 15-minute and the 5-minute squeeze. You have that in your Tesla. You got that in your Netflix. When we're in a swing trading market, my favorite combo is a daily squeeze inside of a weekly squeeze. Can make for a really big swing trade move. They break out the daily squeeze, that fires. That kicks off the initial push. Then they go and wake up the weekly squeeze. That kicks off an even bigger push. For a day trade kind of thing, I like that 15-minute, 5-minute. 5-minute squeeze breaks long or short. That gets the initial push going. During that push, they go and trigger the 15-minute. That gives you an even bigger push. The beauty of that squeeze on squeeze action. So in the current market, I like the 5-minute, 15-minute. I would say from an hourly down, 1 hour, 30-minute, 15-minute, and the 5. I'm liking those right now. But then here's the key. Let me try to find an example. Okay, so if We take the Netflix 15-minute squeeze. We'll do Microsoft 15-minute squeeze. All right, now on that one time frame alone, they are setting the stage for a flush. 15-minute squeeze, 15-minute sell signal, broken trend, structure, all the above. All that does by itself is just set the stage. Pay attention, Taylor. I might want to flush down to about 355. All right, now I need a good trigger and good alignment. What I would then do is say, all right, inside my 15-minute squeeze, let me pop open the hood. I'm going to go look down at my 5-minute. And if I'm going to short that 15-minute squeeze, then my 5-minute should scream get short. All right, momentum, trend, structure, all the above should be aligned for a flush lower. All right, now the 5-minute is pretty bearish, of course, but you don't have the active sell signal. I'd wait for that, then I would jump in and get short. The vast majority of 15-minute squeezes I break short, they have a 5-minute sell signal. So think of Andrew's example. Excuse me. If you think of Andrew's example of the 15-minute ES squeeze from yesterday, do this. Go look at our 5-minute. Right inside that 15-minute squeeze, there's your 5-minute sell trigger. All right, they're all locked up on the same page. Let's jump in, get short. Let's go for it. So that's the key. Taking 2, maybe 3 different time frames. If we're in a swing trade market, you look at bigger time frames. In a day trade market, look at smaller time frames. But then taking them and looking for alignment. So if you're going to work a 5-minute, 15-minute combo, are your momentum indicators bullish or bearish? Are your trend indicators bullish or bearish? Are your structure indicators bullish or bearish? And you want everything on the 15-minute to be in alignment with everything on that 5-minute. If you've got 15-minute bull momentum and then 15-minute bear momentum, it's a tug of war. Everything should be lined up nicely. Yep, David, you got it, my friend. You got it. Alicia, thank you for being here. Good morning. Good morning. Can I take a look at TLT? Yeah, let's go pull up the old treasuries. How is the treasuries market? Popping while the market is dropping. So here's what I would do. I would mark up your 200 SMA. Call it 92.50, and then above that 92.50, can I get a setup to buy it? Could be my next 5-minute squeeze, could be a 15-minute, could be a 30-minute hourly. But in the short term, if they can keep it above that 200, they might have room for higher. Momentum shift, couple lower time frame buy signals, 4-hour, 2-hour, hourly. Yeah, I like it above that 200. I would think back below that, they might take it back into 90 and change. Hey, good morning, MK Infinity. So this is called the Big 3 squeeze, and that's my custom version of the squeeze, but it's built on, let me pull it up here. Let me go grab the OG, the original squeeze gangster. So yeah, you got 3 versions of the squeeze, as far as I'm concerned. You got the original TTM squeeze, which is free on most platforms. Then you have the Squeeze Pro. Then you've got my take on it, which is the Big 3 squeeze. Built on that foundation John started back in, I'm not even sure when, a long time ago. I think I was maybe 19 or 20 years old. One of my mentors called me into his office and he said, "Hey, have you ever heard of John Carter and a squeeze?" I was like, "No, I've heard of neither." So he sent me a YouTube video. I'm watching John's video. He's talking about the squeeze. Uh, Everything for me clicked on that one video. It's like I get it. It makes sense. It's kind of that one thing I was looking for. So what I've done over the last handful of years or so is build up my criteria for trying to trade these squeezes. So I've got my momentum checklist, I've got my structure checklist, I've got my trend checklist. And what I'm looking for is a moment in time where we have a squeeze, and then I'm checking off every single box. All the structure criteria perfectly lined up, momentum, trend, all the above. And when that happens, that's what I call an A plus setup. So going back to that Apple weekly chart, that's an example of the kind of squeeze I want to get long. Wait for my white arrow. When I get my white, I've got the perfect score of 15. 15 means all the trend, all the structure, all that momentum. Right now, Apple has a 0. Can't buy that, can't short that. So yeah, that is the big three squeeze. If you do a YouTube search for big three squeeze, you should find my webinar from last summer. And that'll give you a full rundown of all the pretty colors, the structure criteria, all the fine things associated with the big trace. Okay, Cliff, really good question. What about an iron condor? From an implied volatility standpoint, I think it makes total sense. Calls are jacked up, puts are jacked up, I'm jacked up, we're all jacked up. On paper, I love the idea. Chunky put premium, chunky call premium. How about I go and sell a few, let that premium work back into my pocket? That can work and that could work. The one thing that makes it a little, we'll call it sketchy, it is just the fact that in a bear market, you're going to get your biggest, craziest, most aggressive bounces. It takes a special market for the QQQ to gap 5.5 to 6.5%, and that just be a pop back to an hourly 21. You're in that kind of market. You're in a nutty market. Think about a market. In a normal market, QQQ might go up 6% over the course of a quarter. And now we can do that popping back to falling resistance. So from one standpoint, the IV is so jacked up that it is an attractive idea to jump in, do an iron fly, do a big wide iron condor. That could work really well. Where that won't work well, so like anything in trading, it's a timing thing. Where that won't work well is Monday morning, market opens up flat, we are iron condor, and then Monday just so happens to be the day where you're getting that 1.5 to 5% QQQ pop. That I think is the one risk. We're at risk of more of the same, gap it down, QQQ down 4, 5, 6%, or we're at risk of, all right, we're too oversold, too many folks are trapped short. Here comes a giant short squeeze pop. And that can make any kind of condor pretty tough. So that being said, I don't think it's the kind of trade where you want to open it and then, then go golfing for a week. You could open it up and then actively manage it. And that's where I think it could work really nicely. Days where Nvidia from Thursday is a good example. Pretend this is SPX or NDX. Big gap down, big spike in volatility, but then you don't really go anywhere after the open. Gap it down and chopping, 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 chopping. On that kind of day, I love the Iron Condor. There's going to be a spike in IV at the open on the gap down. And then pretty much all afternoon, those calls and puts are getting all that caked up premium drained right out of them. So I like it a lot if you can actively manage it. I don't like it if it's open it on Monday and then come take a look on Friday kind of thing. Just because of the beast at hand right now. Good question though, Cliff. All right, guys, I think I'm all caught up there. So Andrew, what part of California did you go to? My man Andrew's everywhere. I go on Twitter, Andrew's in New York, Cali, Berkshires, well-traveled man. Hey, Caesar, good morning. My pleasure. My pleasure. Anders, what's up, Anders? Always good to see you. You were expecting some sort of fight at QQQ 450. Yeah, that was my initial thought process. Even going back a couple of weeks ago, like, yeah, we're heavy. Yeah, we're breaking down. But we got that monthly 21 EMA around that 450. So I was thinking back up here and back up here. That might be the mission. Pull back to 450, give that 21 EMA a little smooch on the cheek, and then you maybe stabilize, rebuild, turn the corner, go higher from there. QQQ said, "Hold my beer. How about a dumper for you?" Now we're looking down at 400. we're gonna play that round number game eventually. Okay, 400. Now 380. Now 300. Now 200. Round number by round number. Good morning, Matthew. Good morning, Thomas. Good to see you guys and gals. Yeah, Mike, let me go grab a link for you on the big three stuff here. And we'll finish up Q&A. I'll show you guys a picture from my road trip. And then I'll get you out of here. Let me see. Resources. Let me grab that link for you. There should be a good video on that same page. Here we go. You would think I know my way around the website at this point. So here's what I would say. As a good exercise, watch the video on this webpage. I think you can watch this video and then you can take the free squeeze, apply a few things I talk about in that webinar. You don't have to buy the premium indicator. You could take the original free TTM squeeze, then create some structure criteria, momentum criteria, trend criteria. The squeeze is amazing, but the goal is how can I differentiate between an okay looking squeeze setup versus an A plus kind of squeeze looking setup. How can I gauge when to buy it? How can I gauge when to short it? All the things we got to figure out with the squeeze. But yeah, some good stuff there in that webinar. So I'll drop a link here for you. And there you are, my friend. David, you had a chance to go to Fenway last year and you loved it. Yeah, Fenway Park is a good time. I've gone to Celtics games. I've gone to a lot of NFL games. Baseball is a different vibe. A little bit more low key, a lot more relaxed. I enjoy it. I think Fenway's a lot of fun. You got to get a Fenway Frank, of course. And then Daniel, how are you, Daniel? Am I taking any put swings right now or only focusing on calls? Yeah, good question. So based on the spreadsheet, If I were to take a swing trade, I could only get swing short. Index is too bearish, the Big Ten too bearish, overall market too bearish for me to want to jump in, buy a call, and take it to bed. Now there's a swing trade and there's a swing trade. Could I get a 30-minute buy signal on the QQQ, buy it on Monday night, and then sell it by Tuesday? Yeah, that's technically a swing trade. But then there is, okay, can I buy it in early April, and then I'm going to hold on to it until June, July? To me, that's a true swing trade. I can't do anything long right now for more than maybe a day tops. So yeah, if I were to get a swing trade on the board, it could only be a short. Selling call credit spreads, buying puts. My only little hesitancy for now is just the fact that, um, again, I could be short into the weekend, wake up to the QQQ up about 7%, and nothing will have changed. Based on structure and signals, we can pop up 7%. I would still want to be short. I'd rather take the swing short when we're not 6 or 7% below the hourly 21. So I am thinking, Monday morning we open up flat. From there, either which way, I'm going to have a day trade focus. Open up flat, I can day trade it long, I can day trade it short. If we gap down Monday morning, I can day trade it long, day trade it short. If we gap up Monday morning, I can day trade it long, but I do want to think about that point, getting on some swing puts. Now, QQQ anywhere back into... Here's a good way to look at it. While keeping your risk nice and tight, we can all anchor to QQQ 450. With the thinking then being, I want to get short QQQ on any pop under 450. From there, gauge what kind of risk reward you're looking for. If I short QQQ down here at 420, that basically implies what? Right? If I'm doing it for a swing trade, that implies I'm comfortable taking about 30, 35 bucks of heat. I'm not. I don't want to be short through a 6 or 7% rally. If they gap into 443 Monday morning, all right, now I can jump in, I can get swing short. I can short it around 443, I can cover around 450. At that point, I've got a great risk reward, right? Short at 440, I've got 10 bucks of risk back above 450. I have 20 bucks of risk of reward on a flush down to a new low. If I got short around 440, that's the kind of spot I'm going to jump in and get swing short. So really good question. And don't get me wrong, we can get short all the way down here. And we can do that in a fashion where QQQ could pop into 450, 500 even, and we're not going to take on damage. It's just a position sizing thing. But where can I get short and put on the most risk? As close to that 450 as possible. That'll be our over-under. Okay, MK, great question. So either long or short. The goal for us is always, can we get long or short before the squeeze fires? Big part of that is a concept of the easy part of the move. And gold might be a good example here. You want to be your most aggressive and have the most cash on for the quote-unquote easy part of the move. And what I found, and what Henry's found, and JC has found, time and time again, the easy part of a move on a squeeze is the move off that 21 EMA into about that 2.5 to 3 ATR Keltner channel extension. So rally off your 21, and you rally about 2.5 to 3 average true range moves away from that 21. So looking at gold here from 238 into about 280-ish, into that green line up here, that was your quote unquote easy part of the move. And now probabilities wise, sometime soon gold has to pull back, come back to that 21. So I want to buy, let me get rid of the original squeeze. If I can find find the squeeze, build up my position back here near that 21, I can catch and benefit from a lot of that easy part of the push. Ideally before the breakout, ideally before the squeeze fires. John calls that feeding the ducks. You want to feed the ducks. That means I am buying my calls back here in the chop, in the squeeze, in the quiet, when nobody's really drooling over buying gold. It's not on anybody's breakout scan. It's not on a big volume scan. But we can see the squeeze and say, all right, there might be a big move brewing. We want to jump in, build that long early, catch the breakout, catch the squeeze firing, catch the easy part of that move. Then we take our calls and we feed the ducks. All right, I'm going to buy a GLD call back here for $2. Let it break out, let the squeeze fire, and then near my target, I want to feed the ducks. I'm going to sell somebody else my call for about $5 and change. Buy it back here when nobody wants it. Catch a breakout, catch a squeeze. Near that target, everybody wants some gold. It's on breakout scans, it's on relative strength scans, it's on squeeze scans, buy signal scans. They're talking about it on Twitter, CNBC. Everybody and their mama wants to buy them some gold. You want to be the guy or the gal to give them that trade. All right, y'all want to buy some gold all the way up here? Come on in, water's warm, and I'm going to feed the ducks. Right, you get a call, you get a call, you get a call. And then ideally, they all get hammered. All right, I'm going to buy it back here for 2. I'm going to sell my call up here for about 4 or 5. It will eventually pull back to that monthly 21 or the weekly 21. Then I'll jump in and buy it back again for maybe 3. So really important, you want to catch the easy part of that push. For gold last week, anybody buying all the way up here after the daily squeeze broke, after the weekly squeeze broke, you're now getting caught up in that reversion to the mean. Little bit too late to the party. Gold already broke out. Gold already made a big move. For our sake, it already had fired those squeezes. And don't get me wrong, you can buy them on the breakout when the squeeze fires, and you can catch a nice move off of that. My preference is to maximize potential, not only to maximize your profit potential, but to also keep your risk as tight as possible. Buy them before the squeeze fires, right around that 21 period EMA. And then your other question, when do I cut my trade? I think a good rule of thumb is a close back below that 21. A good strong squeeze or a good weak squeeze shouldn't end up back above or below that 21 EMA. So Apple back here. All right, we're at a point where we have perfect structure, perfect trap, everything lined up, big weekly squeeze. I'm going to buy that call. I'm going to get rid of that call on a close back below that 21 EMA. Whether it's a $5 close back below it or a $50 close back below it, once we get our white arrow, there should be no looking back. They take that and then break back below that 21. That's your first decent heads up. I might be on the wrong side of that squeeze. All great questions, guys. All good stuff. All right, I think I'm all caught up here. Oh yeah, so about go grab that picture here on Twitter. There we go. Yeah, so I'm sure a few of you have heard of this guy, Sam Patrick. And here's his page here, Smarter Trader. He's got his own service. He's got a pretty big following. So he did a live event in New York yesterday. And him and John are doing a little work together. So we hit the road and made a day trade out of it. A day trade. A day trip out of it. A day trip and a day trade. And then I know a lot of you guys and gals know my brother Chandler. That's his girlfriend, my future sister-in-law. She works here at Simpler. And then that is a guy named John. They call him John, the godfather of the squeeze. But yes, it was a really cool event. Imagine 100 traders in a giant room, all trading live together. Laptops, big screens, etc. Let me. I want to figure out what I can actually share from the meetup. So let me talk to a couple of people, and then maybe for our pre-market call on Monday, I can share a few of the gems and wisdom I took from that live meetup. You know, one thing that they talked about though, which I don't do a great job of, is if you never take money out of your account, it's very easy to become. It's just a number on a screen. That you have call it a $50,000 account, and at some point that just becomes a number on your screen, and you kind of get disassociated with that 50,000 of hard cash. So something that Sam talked about, something that John talked about, that a few people in the crowd there, was the importance of, whether it be after every winning trade, every week, every month, every quarter, take a little cash out. I mean, take the cash out, feel it, smell it, make it real. And for me, I've only taken out cash for major, call it life events. I'm getting engaged. I'll take out cash for, took out cash for an engagement ring. Getting married, taking out cash for a wedding. Building a home, taking out cash for a down payment. Nothing fun, of course. A lot to be said for taking out cash and just putting it aside. You have a good week, you make $2,000. Take 500, wire it out, put it aside, build up that nest. It's something I don't do, but I think could be really helpful. It makes it a little bit more real. So I thought that was interesting. Some kind of rule in place for whether it be every week, every month, every quarter, whether it be at a certain account balance, wiring out cash, taking money from the market, putting that into a savings account, putting it under your mattress, putting it into other passions, putting that cash to work. The most interesting thing about that Sam guy, he doesn't do charts or indicators. Not a single chart was open yesterday. He looks at nothing but options premium. So he'll figure out, okay, I should buy the S&Ps, I should sell the S&Ps, just based on the options chain itself and watching premium. If he thinks calls are overvalued, then his take on that is, okay, market maker knows something, calls are more expensive than they should be. There might be a pop coming. Very different than, okay, here's a squeeze, here's stacked EMAs, that technical part of the game. But yeah, let me talk to the team here, figure out how much I can share, and then maybe we can talk about a few more things back on Monday morning. By far, the most important thing that Sam does, that mentality of accept the max loss. And I think a lot of traders will tell themselves, okay, I'm going to buy $1,000 worth of Apple calls, and if they go to zero, I'm okay with that. And a lot of times we're not telling ourselves the truth. We'll say, okay, I'm comfortable losing $1,000 when the real number might be 500. If the real number is 500, buy $500 worth of calls. Not $1,000 hoping for a 50% stop loss. When you can truly accept the risk on the table, it makes the dynamic of options that much easier. So he was talking about cases where he'll have a great morning, he'll make some profit, and then he's very big on parlaying profit into free trades. So, for example, one trade he had yesterday was I forget the exact strike, but it was I think it was a 51.30 put on the S&Ps. He bought that with profit. He bought enough to accept the max loss, and I think at one point that put went against him. But his mentality is very, very, very well aligned for aggressive trading. But yeah, we'll talk more about that on Monday, and then I think I got a few videos, a few things I'll try to share. But all right, y'all, I'm gonna cut you loose here. Good. What time is it? Good hour and a half prep session. I told my wife I'll be done in about a half hour. Went a little bit over. But all right, y'all, as always, thank you for your time on a weekend. Always appreciated. And yeah, I don't think it'll be a dull week ahead here. So just kind of recap my biggest and best pieces of advice. One, keep in the back of your mind, you will get your biggest pops in bearish markets. Thing you want to ask yourself is, did that pop change anything? In terms of signals, in terms of structure, in terms of big over under levels, and we're at a point where we could get a really, really, really big pop. Nothing will really change. Again, take that daily chart on the QQQ. We gap up 13, 14, 15% Monday morning, like an unheard of gap up. Nothing will have changed. It won't be a better looking daily chart. You're not going to have better structure. We could gap up 15%, and I think we'll still have a daily sell signal. But on a 4 or 5% pop, that can be a great plate of opportunity. Day trade pops higher, swing trade your pop shorter till things change. Alrighty, y'all. So as always, I appreciate your time. Have a great weekend. Be safe, stay warm. You got a dog at home, take your dog for a couple of walks, and then back to it Monday morning. I'll be here for pre-market prep, 7:45 a.m. Central, and we'll keep on keeping on with the short-term, in and out, flexible approach to the wild market in front of us. But all right, y'all, thank you again. Any questions, hit me up here in the chat. More than happy to hang out and talk. And catch you on Monday. Adios.